How's it going, everyone? Matt Diamond with Kalshi, and today we're going to be talking about the PDT rule or the pattern day trader rule. The reason why this is important to know is because if you go into the stock market and you want to trade actively, there are rules and regulations against doing so unless you meet the minimum requirements, and I'm going to talk about all that today. So what is the PDT rule? Some people are familiar with this, and I know others aren't, but it's a regulatory designation for those traders or investors who execute 4 or more day trades over the span of 5 business days using a margin account. The number of day trades must constitute more than 6% of the margin account's total trade activity during the 5 business day window. If this occurs, the trader's account will be flagged as a PDT by their broker. The PDT designation places certain restrictions on further trading. This designation is put in place to discourage investors from trading excessively. It's a very serious rule and it applies to all brokers. So if you're considering getting involved in the markets and you go online and try to figure out which online broker is best for you, some of the main pages that come up on Google are going to look like this. And when you click into it, they're going to give you options of brokers that are best in the industry. And when it comes to these, it applies to all of it. So Fidelity, I know another top one is going to be TD Ameritrade. A lot of people are familiar with Interactive Brokers, Tasty Trade. All of these brokers that PDT rule applies to. And in order to avoid being flagged as PDT, the requirements are that you need to have $25,000 in a margin account. And if your account at any point drops below that $25,000, you will be flagged as the PDT if you're actively trading it. So that's why it's very important to have the $25,000. The account cannot dip below it, and it also needs to be a margin account. Now let's quickly talk about what a margin account is for those that don't know. The margin account refers to a brokerage account in which a trader's broker-dealer lends them cash to purchase stocks or other financial products. So let's say you have $25,000 in your broker account. Typically, it's going to be 4-to-1 leverage or margin. So that $25,000 now has the buying power of $100,000. And even though this sounds great, the one downside is that it's putting a lot of risk on the capital that's initially in that account, the $25,000. And a lot of times it can increase that potential for profit, but it also increases the potential for loss. So there's a lot of risk tied to this because if you happen to use a lot of that margin and something goes against you pretty aggressively, that's where those losses can be very big. Yes, it can go the other way where if you happen to use that margin and you're in a trade and it's going your direction, you can have increased profits. But when it comes to trading and investing, you have to think about both sides and definitely the risk that's at play. And this is where a lot of traders can get into trouble because they put in the initial 25, they use that full margin, they kind of take advantage of the fact that they're allowed to do so, they're unaware of the downside risk, and they can really get hurt. Also, when trading stocks on a margin account, depending on the broker where you have your money, there can be a margin fee or interest charged on those borrowed funds. So not only do you open yourself up to potential downside risk, but there can be a lot of fees attached to that if you're using that margin. And as you can see, this is where the snowball effect is happening, not realizing the risks that are attached to it and the potential fees by using margin and those extra borrowed funds. But not only is there that risk, but there's also the fact that many people, when it comes to the financial markets, they're not able to get together that $25,000 amount because that's a lot of initial upfront capital to get started when it comes to trading and investing. And this can be one of the biggest upfront hurdles because I know there are a lot of people who want to trade and invest and they don't want to have any rules about how many times they can trade. So unless you can come up with that $25,000, you're going to have a lot of rules as to how many times you can trade and what you can trade. And I know that there's a lot of people that don't like that, so they just avoid it altogether. So regardless of what your goals are in the financial markets, Kalshi allows the freedom to be able to trade actively the event contracts and not worry about being flagged as PDT. And this is why Kalshi is great because you can fund an account for a very small amount of money. And if you see right here on the markets page, this is all the different things that you can choose to trade as far as the event contracts. And you can see to the right, these are the price of the contracts. So just going to the NASDAQ 100 yearly close, looking at 15,000 or above, the yes is 71 cents and the no is 38 cents. And then if you look at the zone below that, 14,500 to just below 15,000, the yes is 11 cents and the no is 90 cents. So it's very cheap and inexpensive to trade these event contracts. So whether you're an experienced investor or you're a beginner and you're interested in trading the event contracts on Kalshi, just know that you do not need a lot of upfront capital. And not only don't you need a lot of upfront capital, but if you fund your account with a very small amount of money, you can be as active as you want. There are no rules as far as how many trades that you can take within a specific amount of business days. And that's fantastic because it's not fun to be held back by rules and potentially have your account flagged just by simply not having a certain amount of funds to do so. So when it comes to the PDT or the pattern day trader rule applied to the stock market, there's a lot of rules and regulations that you have to think about if you want to actively trade or invest, which can sometimes be a big issue. But when it comes to Kalshi, you do not have to worry about those things at all, which is a massive advantage. Kalshi has many different events on which you can trade those contracts and gives you the freedom to do so as actively as you want. We all know that that's a great thing, and that's why Kalshi is an awesome way to get involved with the financial markets without having to put up a lot of capital up front. So that's it for the video. I appreciate you watching. Feel free to like, comment, and subscribe, and I'll see you in the next one.